Hey guys, I hate to interrupt, but I just wanted to take a moment to say if you're studying for the CPA exams and you like the visual learning approach that we take in this video, definitely check out Universal CPA Review's free trial. You can do this by going to www.universalcpareview.com, or you can click on the link in the description of this video. From there, you could take a sneak peek at Universal's platform, which includes animated video lectures, study guides, and practice questions with task-based simulations that come with video explanations that walk you through the solution step by step, kind of like having a tutor by your side. Okay, enough of that. Let's get back to it.
So as we mentioned, we have two types of options that we're going to cover. We have those that are non-qualified, and we have qualified stock options. So what is the difference between the two? Well, technically the word qualify means that the taxpayer is qualifying for something, which is generally a good thing. So what is it that they are qualifying for? Well, by being qualified, this means that they qualify for later tax treatment. So generally that's a good thing for the taxpayer. But if this is a non-qualified stock option, that means the date that it is going to get taxed will depend on whether this option has what is referred to as a readily ascertainable value. So we're going to start by talking about non-qualified stock options and move into qualified stock options. Because non-qualified stock options can be a little bit more formulaic, which is fine because we've got some mental maps for you. So this should be no big deal. Okay, so again, we have non-qualified stock options that either have a readily ascertainable value or they don't. So that is key because it's going to indicate whether the stock option will be taxed to the employee at the date it is granted or at the date that it is exercised. Okay, so what does it mean for a non-qualified stock option to have a readily ascertainable value? Basically, this is saying that the option is being traded on a public exchange, right? It's being traded in the open market, such as the New York Stock Exchange. If it does not have a readily ascertainable value, then this is an option that is not traded on a public exchange. And the question on your exam will generally indicate whether this has a readily ascertainable value. Okay, so no need to go too crazy pulling your hair out over that terminology. You just need to know what it means and why it's important. So there are 4 tax implications that you need to be familiar with when it comes to non-qualified stock options. On the employee side, we are going to be calculating ordinary income, the taxpayer's basis, as well as any capital gains or losses. Okay, but keep in mind, the employer is still paying the employee in the form of these stock options. So that is considered compensation. So technically, they're going to qualify for a deduction. Okay, so let's start by talking about non-qualified stock options with a readily ascertainable value. And this is again saying that the options are traded on an open exchange. So Dan is receiving stock options from Home Goodies, which is a publicly traded company in this case. So again, let's stick to the 4 tax implications. So let's start by asking ourselves, when is ordinary income going to get recognized? So what you need to keep in mind is that if this is a non-qualified stock option that has a readily ascertainable value, that means that it is going to get taxed as ordinary income at the date of grant. Okay, so Dan signs his executive employment letter and agrees to start work in January, and he's going to get granted his options on January 1st, year 1, but he can't exercise them until January 1st, year 2. So the grant date is the January 1st, year 1 date because this is the date that he was granted those options. So again, if this is a non-qualified stock option with a readily ascertainable value, that means Dan is going to recognize ordinary income as of this date of grant. So how is this going to get calculated? We're going to take the total options and we're going to multiply it by the amount of shares per option. Right, in other words, how many shares of stock will be acquired when these options are exercised by Dan? Okay, and then this is all going to get multiplied by the dollar value per share. Okay, so it's going to help when we go through an example, so bear with me. But most important takeaway from this mental map is that we're recognizing ordinary income at the date of grant when non-qualified stock options have a readily ascertainable value. Okay, so the next step in our mental map is determining basis. So basis will be important when we exercise these options because exercising the options will result in a capital gain. Obviously assuming that the market price is higher than the option price, which is likely the only reason why Dan would exercise them. So we're going to determine the basis in this case by taking the total exercise price and adding that ordinary income that we calculated and recognized as of the grant date. Okay, so the exercise price is going to be the dollar value per share that the taxpayer can exercise these options for, multiplied by the total options that are getting exercised. And again, we're adding that ordinary income amount that we already recognized in step 1. Okay, and then in step 3, we're going to determine any capital gains from the exercise date. Okay, so why are we recognizing this as of the exercise date? Because we're now exercising the options, meaning that Dan is buying back the options at that lower price, and he's going to subsequently sell them at the higher market price. So if Dan is being granted these options as of day 1, and he's going to exercise them on day 2, then this is the date that he is exercising them at that later date. Okay, so this is essentially the sale of any capital asset. We're taking the fair market value, right, aka the selling price, and we're going to reduce this by the adjusted basis, right? We already determined that in step 2. And then finally in step 4, we're determining the employer's deduction amount. So Home Goodies is still providing Dan with these options. That is essentially part of Dan's wages. So that means that Home Goodies can take this as a deduction as compensation expense, right? This is ordinary income to Dan. This is an ordinary expense to the company. Okay, so the question becomes, when can they take that deduction? In what period? And the answer will always be that the employer can take a deduction in the same period that the taxpayer recognizes ordinary income. Okay, so again, if this is a non-qualified stock option with a readily ascertainable value, we know that the taxpayer is going to recognize ordinary income on the date of grant. So that means that the employer can also take a deduction on the date of grant. Okay, so what happens if the taxpayer does not exercise the options? So basically we're saying here that Dan decides it's not a good result if I go ahead and exercise this, right? We know that the market price is less than the exercise price. So the options lapse. And if the options lapse, Dan is going to qualify for a capital loss deduction. So how much can Dan take? This is a little bit different from if this does not have a readily ascertainable value. Basically, if the non-qualified stock option has a readily ascertainable value, the capital loss will be based on the amount that the options were previously taxed up to this point.
Let's take a quick break and catch our breath. Woo. If you like what you see in this video, well, you're not alone. Okay, many students who studied with Universal CPA Review have found a ton of success. And if you don't believe me, you could take a look at our reviews on Trustpilot. Trustpilot is the most legitimate third-party review site that ensures that our reviews are completely legitimate. Universal CPA Review is not only the best CPA exam study option for visual learners, but it's also the most cost-effective option out there. So if you've already spent thousands of dollars on another CPA review course, we totally understand, and we want to help you out. So take a look at our free 7-day trial and see if Universal CPA Review is for you. You can start your free trial by going to www.universalcpareview.com, or you could take a look at the link in the description of this video.
Okay, so we have 2 examples we're going to run through. And again, we need to remember the 4 tax implications when it comes to these non-qualified stock options. So let's run through it. Dan received 50 non-qualified employee stock options from his employer, Home Goodies, Inc. Each option has a readily ascertainable value of $2 per option. Each option will provide Dan the right to repurchase 10 shares of the company's stock for $5 per share. Dan received the options 4 years ago when the stock price was trading for $6 per share. Dan exercised all of the options when the stock was trading at $30 per share. So let's start by asking ourselves, what amount will Dan recognize at the grant date? Okay, so when thinking about the grant date, this is the date that the options were granted to Dan. So what income amount will Dan need to recognize? So we're first thinking about ordinary income. And if the options are considered non-qualified stock options with a readily ascertainable value, that means that they will be recognized as ordinary income on the date of grant. Okay, so this is going to be calculated by taking the 50 options that Dan received, multiplying them by the amount of shares that Dan will acquire when converting these options, and then we're going to multiply this by the option's readily ascertainable value. Right, the value that we could see when we take a look at the open market. Okay, so 50 options times 10 shares times $2 per share, right? This is the value that it has, which is its readily ascertainable value. Okay, so $1,000 is the amount that Dan will recognize as ordinary income on the grant date. Okay, so just a little side note, what does this mean for the employer? Dan's employer, Home Goodies, will be able to take a deduction as of the same period that ordinary income is recognized by the taxpayer. Okay, so because again, this is a non-qualified stock option with a readily ascertainable value, Dan is going to recognize this as of the grant date, which means that the employer will be able to take a deduction for the same amount as of that grant date. Okay, so in the same year. Okay, so let's take a look at another example. Same information, only now we're going to calculate Dan's basis in these non-qualified stock options. Okay, so they still have a readily ascertainable value. Okay, meaning we can go step by step in our mental map. All right, so in step 1, we still need to determine that ordinary income amount, which is going to be the amount recognized as of the date of grant. Okay, so $1,000 is still going to be included in this basis. But we now need to determine the amount that would be recognized as of the exercise date as well. Okay, so if Dan is exercising these options, we need to make this calculation based on how much Dan would spend if he bought them back. Okay, so each option will provide Dan the right to repurchase 10 shares of the company's stock for $5 per share. So we have 50 options that he can buy back, which will allow him to acquire 10 shares per option. So 50 times 10, and then we're going to multiply this now by $5 per share, right? We're not multiplying it by the amount that the stock is selling for. We're multiplying it by the amount that Dan could buy this back at, which is $5 per share. Right? Think of this as an option contract. Basically, Dan's locking in the option to repurchase this stock at the $5 per share price. Okay, so this total exercise price is now going to be $2,500. So $2,500 is what's getting added to the $1,000, which is going to give us $3,500. That is Dan's basis. Okay, so if the question asked us to determine the capital gain, we would take a look at this and treat it as if it was the sale of any other capital asset, which is essentially the sales price less the adjusted basis. Okay, so assuming Dan exercised the options when the stock was trading at $30 per share, that would mean that the adjusted basis, as we determined, was $3,500 when Dan was selling them at the $30 per share amount. Okay, which would be $15,000 less the $3,500 adjusted basis. And absolutely Dan would exercise these options because the sales price is much higher than that price he would have to repurchase them. Okay, so $11,500 would be the capital gain if Dan decided to exercise the option, which would be recognized again at that exercise date. Okay, so what about the employer? They're still not going to recognize anything as of this date, right? They already recognized their deduction as of the grant date because once again, this is going to be a non-qualified option with a readily ascertainable value.